Personally, I think the stock market is nuts right now. The broadest market indexes like the NASDAQ have tripled in value from where they were just 6 years ago. The S&P 500 is up 135% from 2020. And to make things even more confusing, from February to today, we've been at war for the last 5 months. And as you all know by now, the Strait of Hormuz has been closed. We've lost upwards of 20 to 25% of the worldwide oil and gas exports. In addition, we've lost critical fertilizers needed to feed literally millions of people. At the same time, we've lost helium exports. And helium is indispensable in modern chip manufacturing. And those very computer chips are needed to build out the whole AI revolution. And that's the foundation that the whole stock market and economy are standing on right now. And having said all that, the stock market doesn't even seem to care in the least. You've got to admit, that's really fascinating. This is looking at the market from the 30,000-foot level. We're going to be looking at macro trends, price to earnings ratios, right here. We're also going to be looking at the Case-Shiller price earnings ratios, right here. We're also going to look at the price to sales ratios. That's right here. We're going to take a look at the price to book value. It's right here. And we're going to be taking a look at the price to earnings yield, right here. If you're either trying to buy or sell commercial properties, we can help. You can reach me at johntemple@expcommercial.com. First, let's look at the NASDAQ. There are over 3,000 stocks in this index. It's a really good measure of the broad market. In 2020, it was at 8,000. Today, it's over 24,000. That's 3x. That's over 3 times what it was just a little over 5 years ago. I mean, that's amazing. Next, we'll look at the S&P 500. This is the S&P 500. It's up over 21% this year, even with a war, and it's up 135% over the last 6 years. Again, that's nuts. Next, we'll look at the price earnings ratios. This is a historical chart of the price earnings ratios. Currently, PE multiples are hovering around 30. Historically, they've been around 15. And this index goes all the way back to 1928. And that's a long time. Point being, we're currently double that of historical averages. Let me stop for just a second and try to explain what price earnings multiples are, just in case you're not that familiar. Let's just say, for the sake of illustration purposes, that this little box, it's an iPhone, but let's call it a little box, is a money-making machine. And every year, it's running at full speed. It can kick out $1 in profit. Okay? Question: what is this little money-making machine worth if it kicks out $1 every year? Well, historically, people would be willing to pay, say, $10 to $15 for such a little money-making machine. The thinking goes something like this: if this little money-making machine can kick out $1 every year for the next 10 to 15 years, at that point, I'd be getting my money back, and from then on, I'd be all profit. Here's the problem. Let's say that the PE ratio is 30, just like it is today. That means it would take about 30 years to get my money back at $1 per year. You might conclude, holy cow, by that time, it's a long time. I might be dead by then. Therein lies the investment quandary. What is a fair price earnings multiple? Next, we'll look at the Case-Shiller PE ratio. This is the Case-Shiller PE ratio. It's at 42. A note to point out, that's the highest it's been in history. The only time it's gotten this high was during the dot-com bubble in 2000, 2001. And that's only because prices dropped so fast overnight that the price earnings multiple doubled, not because of earnings expansion, but because of the price it dropped in price. The Case-Shiller PE index goes all the way back to 1871. That's 150 years. And again, here's the point. The market has never been priced this high. Next, we'll take a look at the price to sales ratio. This is the price to sales ratio. Of all the pricing models, I like the PSR, or price to sales ratio, the best. It's really simple. Let's say the PSR is 1. That means, in effect, that the company is worth 1 year's annual revenue. If the PSR is 1.5, it means that the company is worth 1.5 times its annual revenue. Again, that's pretty simple. The historical average price to sales ratio is around 1.5 times annual revenue. Today, we're at 3.74. That's 2.5 times higher than the historical average. Again, ouch. Next, we'll be looking at the price to earnings yield. This is the price to earnings yield. The point being here is that the higher the price you're willing to pay, the lower the effective yield would be. Currently, the price to yield is at 3.07. That's on par with where we were during the Great Depression of the 1930s. The only other time we've gotten this low was during the 2008 recession. Next, we'll look at price to book value. This is the price to book value. This is a good pricing tool if you're looking at a company with lots of physical assets. Historically, the market prices this type of company at around 3 times book value. As you can see, today it's around 6. That's 2 times higher than historical averages. Well, you might ask, what in the world is going on? Here's my take. It all comes down to concentration of wealth. Today, 88% of the stock market is owned by just 10% of the population. At the same time, just 7 companies, NVIDIA, Microsoft, Apple, Amazon, Google, Facebook, and Tesla, are worth or are capitalized at around $20 trillion. Now, obviously, that's a lot of money. But if you look at the total GDP of the European Union, that's 27 countries. Their cumulative GDP is around $25 trillion. So just these 7 companies are about 80% the size of the European Union. And if that isn't profound enough, the top 4 money management companies in the U.S. control $36 trillion. BlackRock, about $14 trillion. Vanguard, I think, is like $12 trillion. Fidelity is about $7 trillion. And the Capital Group is like $3 trillion. Via the privilege of the proxy vote over shareholder rights to control the board of directors in a company, who actually manages the company are these 4 money management companies that have enormous influence over the power of corporate America. The point being to all of this is that the concentration of wealth is enormous. And the bottom line is this. These kind of people don't have to sell their stocks to, pay bills at the end of the month. Now, if you want to keep up with the market, just hit subscribe and the like button, and I'll be back next month with another review of the stock market. If you're a real estate broker, either on the residential or the commercial side, and are looking for a change, give eXp a look. Free to reach out to me. Feel free to reach out to me at any time at johntemple@expcommercial.com.